Okay, so why don't we start? Uh, so I guess today's topic is strategies for investment success amidst market volatility and elevated prices. Uh, I had taken a similar webinar about a month back, where I had mentioned that I do think that Fed will at some point in time pivot, where I had mentioned that I do see rates coming off next year. Uh, so we obviously got that result a couple of days back, and so I thought it's a great idea to talk about it, and talk about what should we actually be as investors do going forward. So what I'd like to do in this presentation today is talk about markets, how they've actually behaved, uh, talk about how different kind of asset classes have moved, talk about the India story, and then talk about my personal ideas around what one should be doing as an investment going forward, and then we can open it up for Q&A. We'll probably have this session for first 20-25 minutes. I'm going to speak, and then we'll open it up for Q&A, and please feel free to ask any questions. Dhaval, can we go to the next slide, please? So the key takeaways from the US Fed, it's very, very clear that Powell has now pivoted and the Fed has pivoted. Till date, they kept talking about or harping around how rates need to be high because inflation was very sticky. But the last Fed meeting is very clear that the increase in interest rates has actually taken a toll on the economy in a way. Inflation has starting to come off and is no longer sticky. And the Fed is very, very confident around a soft landing. So the Fed is talking about a 75 basis point cut next year. I personally think that the cut could be as much as 175 basis points, and I'll explain why later. The personal consumption expenditure forecast has also been revised. They're showing a revision down from 3.7 to 3.2, which is again extremely positive for the markets. The core inflation forecast is also down. They've now lowered it from 3.2 to 2.4. As we all know, the Fed's target is 2%. And what the Fed is mentioning is you might actually see 2% in 2025. I personally see that happening even earlier, and as early as next year. Next slide, please. So how did the US markets react to the Fed? I mean, firstly, this was not expected. Everyone I spoke to before the meeting, they actually mentioned that the Fed chairman would keep talking about inflation being high, and they'll have to be extra careful around cutting of rates. So this was actually totally unexpected. And the markets rallied a lot. Basically, the Fed here was agreeing to the traders or agreeing to the market, because the market had earlier anticipated that Fed would actually start cutting. And here they were hearing from the horse's mouth that they would actually be cutting rates. So NASDAQ, which is the tech-heavy index, was up 1.38%. The Dow was up 1.4%. The S&P was up 1.37%. And for the first time, the 10-year Treasury dropped below 4%. Keep in mind that 3 months back, or 3.5 months back, this yield has actually touched 5%. And mortgage rates, 30-year mortgage rates, had gone to 8%. Today, for the first time, the mortgage rates have actually come below 7%, and 10-year Treasury yield has dropped below 4%. And I think it will continue to drop further. I really don't see rates going up at all, especially as expectation of rate cuts start coming in. Next slide, please. So this has been the global indices performance. So India, as you know, has performed reasonably well. Obviously, the mid cap has done extremely well, this mid cap and the small cap. The larger companies have not done well, though I do feel they'll actually start catching up very quickly. In the US, obviously, the Magnificent Seven have helped propel the NASDAQ. It's 48, but as of yesterday, it was close to 50%. Dow is up 10. S&P is now actually up almost 22.5, 23%. One of the markets which has actually not performed is, and not surprisingly, is China. China's got its own problems. Started with politically a few years back when they went after the large tech companies. They've actually been they're having a lot of problems around the property sector, and because of that, China has massively underperformed. The Hang Seng is actually down 12%, and the Shanghai is down on 3%. But overall, if you see, the markets have performed reasonably well, and this was, in fact, beginning of the year, if you had seen, most of the analysts actually thought that the markets would not do well, but most of them actually have been proved wrong, and a lot of people are now playing catch up. A lot of the hedge funds are playing catch up. A lot of the mutual funds are playing catch up. So definitely, I see this actually rally continuing going forward. Next slide, please. And now let's look at Indian data. Now we've looked at the US, we've looked at overseas markets, and now let's look at India. Inflation, I mean, CPI's goal of 4%, it's slowly and steadily coming down. It's very clear, as you can see from this charts. The core CPI has come down to close to 4%, and is actually looking very good. And I have to compliment the central bank for this. I think the governor has done an amazing job in monetary policy, which has really helped keep a lid on inflation. Next slide, please. So this has been the RBI stance. Obviously, they continued to hike May, June, August, and the hikes were quite aggressive, I would say 50 basis points and then 35 basis points. And the last, I guess, 5 meetings, they've kept the repo rate unchanged. Now with Fed clearly indicating that they are planning to cut rates by 75 basis points, and I think actually they could cut more, you will see the RBI also following through. I do see rates coming off. My feeling is that between March and May, you will see cuts coming through. And that's one of the reasons why the markets are going well, right? Markets are doing very well. Today I was looking, the Sensex is up 900 points. Yesterday it was up. I mean, there's a reason why markets are behaving the way they are. I mean, this has been a very sudden and a very welcome pivot from the largest central bank. And that's really helping the markets propel. So going forward, keep a close eye on RBI. I think they will be cutting rates and would not be surprised if they cut by 150 to 200 basis points next year. Next slide, please. If you look at the P multiple valuations, they're looking really good. I mean, it's aligned to the 5-year average. The forward Ps are around 21.7. And you know, it's just, I do think that valuations are not stretched at all. In fact, despite the markets going up, the valuations are extremely reasonable. In fact, some of the growth stocks which do not really have profits, they actually should start doing well or even better as rates start to come off. So players like Zomato, Paytm, and all these guys should in fact do very well in a lower interest rate environment. But just looking at this chart, I think forward Ps are looking great. In fact, even suggesting that it could be even not a bad idea to even enter the market now despite the markets having gone up so much in the last 2 to 3 days. Next, please. Let's look at the overall India story, right? I mean, elections, the state elections were amazing. With BJP coming through in 3 out of 4 states, I mean, a lot of people are talking about that. It's a clear foregone conclusion that the same party is going to come back in the next elections, middle of next year. So on the political side, obviously, it's looking very healthy, steady, very good. Some of the GST collections have been amazing. They've just surpassed 1.5 lakh crore mark, signaling robust economic growth. And this has happened for 9 consecutive months. The FPI flows, I think it's only increasing, and it's going to keep increasing going into next year. I think what's helping India is obviously a very stable government, great infrastructure spend. The government has been spending a lot on infrastructure, also trying to create employment in the country. And also what is helping is the flows which used to go to China are obviously coming to India. In fact, a lot of the investors have actually mentioned that China has become uninvestable. It's becoming so difficult to invest in China given what's going on. And India obviously is a big beneficiary to those flows. So I think honestly, next year it's only going to accelerate a lot of these flows which were going to some of the other emerging market countries. Upward growth provision, obviously the RBI has updated its growth forecast. I would not be surprised if we blow through 7%. I mean, there's a lot of optimism in the country's economic trajectory, and reasonably confident around how we do next year. Next slide, please. What could drive India's growth? We spoke about recent elections. I mean, the gross capital formation as a percentage of GDP, that's finally is also seeing an uptrend after a decade-long downtrend. So that's very, very positive. Capacity utilization is pretty much at its all-time high. Industrial order inflow has been on the rise year on year. And as per estimates, it's expected to grow at a compound rate of 18% over the next 3 years. So all these are extremely, extremely positive. So if I look at, is there anything really negative going on? At least in the near term, it doesn't look like. I think we are benefiting around capital inflows. We are benefiting around doing better than emerging markets. We are probably one of the only countries growing at 7%. I think the red tapeism is definitely coming off. The infrastructure build has been amazing. I mean, I'm spending a lot of time in India these days, and I can see the difference in infrastructure and what's been happening. So I think overall, looking extremely, extremely good. Next slide, please. So I guess this is the million-dollar question. We've seen what the Fed has done. We know exactly that everyone's looking at a soft landing in the US. Unemployment is at a reasonably low level. So pretty much everything is pointing out to inflation coming off. It's the Goldilocks scenario, right? Everything is starting to look good. And Fed has suddenly turned around and said, you know what? We agree with you and we are going to cut rates now. So what should we do? Should there be a lot of caution given the fact that equity prices have gone up a lot? I mean, if you look at the US, November, we saw S&P going up by almost 8 or 8.5%. December, it's already up 4%. In India, indices have gone up. The power sector is up almost 7 to 8 or 9% in the last 1 month. So what should we be doing now? My suggestion is, and my thinking is, stay invested. This is a time, I think the bull run has started obviously a few months back. In fact, my last LinkedIn post also, I said the bull run, is the bull run really starting? And that was a few months back. Yes, I think the bull run has started. I do think this is the beginning. yes, prices have moved up, but I do feel that next year the S&P from here could be up as much as 7 to 10%. And don't forget, the S&P is already coming back to it's at 4720. The last high was at 4800, which I think will probably get breached before end of December. So I do see markets continuing to rally. Obviously, it cannot be a one-way direction. So there may be times where there are sharp pullbacks, and you should have enough dry powder. So if there's a correction of 3 to 5%, that you actually go in. So it doesn't mean that you're all in right now, but you should, if you had invested, continue to stay invested. In India, there are certain sectors which have underperformed. The large cap has underperformed. I think they will perform. I think the banks will perform very well. I think the pharma sector will perform reasonably well. IT sector, which has underperformed, I think that will do well. And power and infrastructure will definitely continue to do well. So all these sectors, I think, should do well, but keep some dry powder so that as and when markets correct, you are ready to pounce on that and keep getting in. So stay invested. By trading the markets, I don't think anyone really has gained going in and out. So just stay invested in the markets. That's one. On the fixed income side, I think the rally will continue. I think the rally will obviously not be as strong as what's happened in equities. So do keep that in mind. Around gold and silver, I do see gold going up. And it's mainly because dollar weakness will be there. So I would have also said rupee would appreciate, but typically RBI starts collecting dollars as rupee starts to appreciate. So though you might see a bit of appreciation, I don't think it's going to be as much as compared to some of the other emerging market currencies. And there's a reason RBI is collecting dollars and taking up their reserves. Do I really see rupee depreciation? Not really. I mean, I think over the next 4 to 5 years, rupee probably will depreciate only 1.5 or 2% per annum. So I don't see that happening. Oil is tricky. I think as consumption starts picking up, I think oil prices should go up, though they are under a lot of pressure right now. But I do see that picking up. So if you would like to go long energy, it's not a bad time to actually go long energy today, given that prices have come down. Real estate, I think real estate continues to do well. I spoke last year also, the last month also. I think commercial real estate should outperform residential. Residential mainly because it's moved up quite a bit and the yields are very low. Commercial, I think, given that rates will actually come down, I do think cap rates will come down. So commercial should relatively outperform residential. So overall, I continue to say that the asset market should do well, but do not be complacent. There will be corrections, and corrections could be quite steep. Given that the markets have rallied so much, you might see corrections of almost sometimes 5 to 7%, and 2 to 3% sometimes in one day. So be ready for that. Have a strong stomach, but do make sure that these are opportunities when you actually get into these markets. What else I would also suggest is, if you don't follow single stocks, do get into mutual funds, do get into ETFs. I think that's one of the best ways to do it if you don't do single stocks. Like, for example, me, I don't follow single stocks on a regular basis, but I like the power sector, I like the banks. So I definitely go into mutual funds in India who are long these. If you're investing in the US, there are a lot of very good ETFs, SPY, QQQ, XLK, Russell 2000, there's an ETF. So do continue to go long them. But overall, I think fortunately, I think it's looking good. And I think we should be happy that all the central banks have actually now said that they will actually follow the markets. I was very, very surprised by the Fed statement. But honestly, it's great for the investor community. So do enjoy it till it lasts, but always be cautious. So thank you for that, and let's open it up for Q&A. Do we have any questions? Shivam, do you want to ask any question? Okay, so there's a question from Mihir. Isn't the US trying to surprise the market positively just from election perspective, since their national debt and GDP continues to be weak and long term looks weaker? That's a great question. In fact, there's been a lot of debate around how come Powell has done this suddenly. Has he been influenced by Janet Yellen? But on there's no end to debating around this. It's a possibility that it's definitely possible, because if the markets do well, typically the incumbent president they tend to come back. So there could be a chance that that's happening. But given the fact that everyone says that the Fed is very independent and they take their own decisions, it's actually anybody's guess. I'll be very honest, Mihir. But that's a great question. What's your view around the IT sector? I think I'm very reasonably positive around the IT sector. I think the IT sector should continue to do well. I mean, they've underperformed over the last 4, 5, 6 months, but I definitely see it actually performing reasonably well. How the REIT will develop in India? I think there are two parts to it. One is, of course, the publicly traded REITs, and one is the MSM REIT. As you know, SEBI is now going to regulate the fractional players, and they're calling it MSM REIT. I think it's early days. They're going to be coming out with guidelines probably in a month or 2 months. But I think the development will be huge. And I think over the next 3 to 5 years, this will be a huge market, which is traded on a SME exchange. There'll be two-way flows, and definitely the liquidity will improve. One thing I have realized, that India follows the US model, but in a lag. So 4 to 5 years time, the following of the US market actually becomes very, very strong. So I do think that will happen. REITs in the US trade very, very actively, and I do see that also happening in India. So Ritesh asked me the question, what's your take on Indian startups in this environment? That's a very good question. The VCs and the private equity have not been funding a lot of the startups. In fact, I think this year it's fallen down to 30% of what they had funded last year. Now, with rates coming off, obviously it becomes very, very attractive to start investing again. So I do expect VCs to start investing again, and I think they could be investing very, very aggressively. Earlier on, they were just, a lot of them are sitting on cash and earning interest, but now that's going to start coming off, and it's going to start hurting as investors ask you questions around the returns. So my take is the funding should definitely improve for the startups, which is great for the startup ecosystem. What do you exactly mean by soft landing of the US economy? What it really means is inflation continues to come off. The data clearly shows that the companies are actually continue to do well. Results. So as the results keep coming, companies are doing well. Inflation is coming off. Consumer spending continues, which then helps the overall GDP, and that's what I mean will actually happen. In a hard landing, typically what happens is data or companies do very, very badly despite because the rates have gone up, and inflation doesn't really come off, and that becomes a big problem. Question by Sushil. How much can we expect growth in commercial office space in India over the next? Uh, I honestly think I wouldn't venture an exact number, but I do feel a lot of foreigners are actually setting up offices in India, and with the dollar where it is, they're really spending $1 per square foot on rentals. So I actually think as manufacturing shifts more and more to India, definitely the growth is going to be huge. I would not be surprised if it grows anything between 10 and 15% in terms of CAGR. What should the new investors do at this stage? They have missed a major rally. There's always an opportunity, I feel. Personally, I would start investing. If you've not invested anything, and if you want to invest 100, why don't you invest 20 now? Wait for corrections and keep investing. I mean, this is a market I think will give you enough opportunity. As I said, markets could correct 3 to 5%, but you can never really time these markets, right? You want to invest 100, you start investing with 20 now. Watch the markets for a while. Don't be in a rush. Patience is a virtue, as I always say. Take your time and continue to invest. Just make sure you invest in the right sectors, because there's always a rotation of sectors which happens both in the US and India. Like, for example, the Magnificent Seven did really well in the US. The banks have started doing extremely well now. I'm sure the Russell 2000, which is the small cap and the mid cap, will now do. So just make sure about that. But I don't think you've really missed a major rally. I think the rally continues. Question: how would cuts indirectly affect the real estate market in India? As I mentioned, very, very, very bullish around the real estate. As rate cuts happen, cap rates in commercial come down, which effectively mean property prices go up. So this is, if you ask me, this is probably the best time, and as I mentioned about a month back also, to invest in commercial real estate, because rates, I think, over time will come down, property prices will go up. So if you have a 5-year horizon, you could easily make 17 to 19% IRRs without leverage. So someone mentioned, can you please share a bit about your organization and how, as an advisor, we can benefit? So we are a fractional real estate player. We are in the top 3 in India. It was started by a Harvard MBA undergrad, and he's an undergrad from Stanford. He's the founder. I joined as co-founder and CFO 18 months back. My background is I'm a chartered accountant and MBA from IIM Ahmedabad, 1989 batch. I worked 33 years in banking with Bank of America, UBS, JP Morgan, and Nomura. And in Nomura, I co-ran sales globally across all fixed income and equities. We can take this offline. We are very, very happy to work as advisors with advisors who can help expand our investor base, and also on the acquisition side. Happy to do that. Your thoughts on the India story and insulation to any shocks in the US economy? So one thing, I honestly think the India story obviously is extremely, extremely good. And insulation to any shocks, the problem is there cannot be any insulation. And the reason is US is such a large player that anytime US does badly, typically it will affect all the other countries. Obviously, India to some extent is insulated because it's a large domestic economy. But is it going to be completely insulated? I don't think so. I personally don't see too much of shocks in the US economy. But to answer your question, insulated, yes, but completely, probably no. Your thoughts on the Indian chemical sector, sir? Unfortunately, I'm not an expert on the Indian chemical sector. We are happy someone will follow up with you and and give you their thoughts from hBits. I'm unfortunately not an expert, so I don't want to say anything which is wrong. So great question. Also, everything looks great for India. What could be the negative factors which could which could impact growth or throw all our positive assumptions? So one could be, if there's a change in government, then what do you do, right? New government comes, it takes time to settle down. That, I mean, it could happen. Never say never, but these things can happen. So that's, I think, one of the biggest risks. That's one. And secondly, I would say any kind of political conflict or globally, or conflict in terms of like what happened in Ukraine, what happened in the Middle East, something which is not fathomable now. That could impact. So far, if I look forward, it doesn't look like it. But as I said, never say never. Do you think that SME REIT will bring more investors, which might put pressure on rental yields? So SME REIT obviously will open it up for more and more investors, given the fact that SEBI is now going to take the ticket size down. I think the rental yields are only going to come down. I'll be very, very honest, because I think over time you'll see more and more investors coming in. And if rates are going down, which means fixed deposits are going down, then really the only comparison is then going to be with equity markets. Equity markets over long periods of time give you anything between 11 and 12 and 30%. It might be different now, given that equity markets are going up, but typically 11 to 12% is what you get. So I think with the SME REIT market coming up, more and more investors coming into this, more and more retail investors coming in, I think yields will continue to come down. But I think it will take time. It's not going to happen immediately. As more and more investors get comfortable around the fractional piece, definitely believe yields will come down. Can we see some SME REIT like mutual fund business in the next 5 years? Absolutely. It may not happen, I think, in the next 5 years, Kshitij, but going forward, will it happen? Absolutely. I would not be surprised if it happens in 6-7 years. I mean, the chairman of SEBI has already mentioned that now she's saying the minimum ticket is 10 lakhs. She wants to probably get it down to 1 lakh in a couple of years' time. And who knows, this will continue to come down as it trades on the exchange. I think the difference really is that real estate is not as liquid as some of the other asset classes, but over time, this will only create liquidity for the investors. Your views on luxury residential market and pricing growth in India? Luxury residential market is a very peculiar market because a lot of it is for trophy properties, as I say, right? I was talking to someone in Mumbai. There's a transaction which happened for 230 crores or 150 crores. Some of the bungalows went for probably 500 crores. A lot of the real estate goes for 10, 15, 20 crores. So that's a very, very different market. It's for people who normally want to stay in those places. And with the wealth being created, a lot of people are actually splurging on that. So I think it will always be there. Will it be growing? So it's obviously grown in the last 2-3 years in terms of percentage growth. Will it continue to grow? Yes, but at a much lower growth rate, I would say, because the last 2 years it has moved up quite a bit, and it's really a buyer's market in terms of people who want to actually stay in that, or users market, as I would say. How will be the future of fractional investment? I've mentioned that. I think it's looking amazing. With SEBI coming through, I think it's only going to be better and better with more and more liquidity. Yes, I do see Sensex probably growing by anything between 7 to 10% going into next year. Do you have any concerns around a deflationary cycle ahead with the falling rates, etc.? Not really. I actually don't think so. I think there's enough indication around that there are inflationary pressures. So I think the deflationary cycle, I don't see it happening, at least in the near-term future. Do you see any real de-dollarization partially, at least? If yes, what will be the impact on trade? So the answer is no. I do not see this happening. This de-dollarization, a lot of people have been talking about it. People have been saying the China yuan will take over and euro will take over. I don't see it happening. What could happen is countries could have treaties, like India had a treaty with Russia around rupee. Similarly, as you mentioned, India, UAE trading in INR, that could happen. But it's not really about de-dollarization. It's about just, I guess, becoming more comfortable using each other's currencies as such. But dollar will definitely remain for most of the trade. Considering interest rates coming down in 24, would yields on future real estate assets come down? Absolutely. I mean, it's all driven by cap rates. Obviously, there's a lot of demand and supply also. So if there's no demand and there's a lot of supply, then they may not come down. But logically, I think there'll be a bit of delay. I mean, it might be maybe 9 months to 12 months delay, but definitely I see it coming down. When can we expect warehousing investment from hBits? We are working on it. I'll be very honest. We've identified a few warehouses, but there's a lot of due diligence which has to go on. So you'll have to give us some time. I guess in the next 3 to 4 months, we are looking to launch properties in Bangalore, Pune, a lot of properties in Bombay. But these will be mainly commercial properties so far. Do you think the stock market index will be 90K from 70K? Not in the immediate future, I would say. As I mentioned, I see it going up by 8 to 10%. So stay invested. Equity markets over long periods of time, as I said, give you anything between 10 and 14% returns. How safe is investment in shared commercial property in India? How safe it is? What are the risks? Honestly, very, very safe, Sushil. I've personally invested in fractional real estate also. Obviously, you've got to invest with the right company. You've got to invest with the right management. So that's very, very important. So safety, not a problem. Risks, the only risks I would say are, if the property is not leased, then you have to, the asset manager will lease it for you. So that's one kind of risk which you have to live with. But we have enough typically time to lease the property again. Typically, there's a notice period of 6 months. So as long as the micro market is good, as long as the building is good, typically we will never have problems. So 90% of the time, you will not have these problems. So the risks are reasonably limited. I would say with upside of almost 15 to 18% in terms of IRR. Exit options, Paragji, 2 exit options. One is your investor can exit anytime on the platform. It takes us 30 to 45 days to exit the person, so that even if you do it after 6 months, that's fine. We typically would exit the property in 4 to 5 years when we see the proper capital appreciation. So we typically tell people that stay invested for at least 4 to 5 years. What is your view on commodities like metals, gold? As I mentioned, I see this year gold going up by anything between 6 to 8% into 2024. So question from Praful, you're very bullish on real estate, but why most foreign companies are exiting? Also, some firms are not even able to find buyers. I don't know whether you're talking about India or you're talking about the US. US obviously is very bad because work from home continues, especially around the West Coast. In India, that's not a problem at all. Pretty much everyone's now working from the office. And exiting commercial real estate is actually very, very easy. As long as the building is good, micro market is good, normally is not a problem. But Praful, if you want more answers, happy to get on a call with you. or if you want to get on a call with hBits, happy to do that. In this Goldilocks, environment, do you see HNI time horizons change for any asset classes? So I think next 1 year, I would definitely say is looking good. If I was to take a guess, I would say 18 to 24 months is looking actually good. Beyond that, there are so many other factors which affect these asset classes, especially political factors, which no one can really fathom what will actually happen, because no one knew what would happen in Ukraine, Israel, and Hamas. So I would not take a guess beyond 18 to 24 months, but I would say beyond at least 18 to 24 months is looking reasonably good, I would say. Please guide on hotel and resort sector growth. I do feel this sector will continue to grow. I do see it. The demand is very, very robust as travel comes back furiously after COVID. Very bullish around this. Not sure around the rentals you can get around, especially around resorts, or the rental yield which you can get. But generally around growth, it's actually looking very, very good. So I think I've answered all the questions. Happy to, if there are any more questions, happy to take them. Or if not, if you want to write an email to us, or if you have any thoughts, happy to take that too. But I'll wait for a few minutes to see if there are any more questions. So there's one question. Any thoughts on investment in senior citizen living? Nafis, we've actually not looked at it. We've looked at student housing. We've looked at resorts. We haven't looked at this. But if there's something interesting, we would be very, very happy to do this. And not only from a yield perspective, but I think as a good citizen, we would definitely like to do this. I haven't seen it, but I will tell my team to look at it, definitely. So if there are no more questions, let me wait for a minute or so to see any more questions. I guess there are no more questions. Thank you so much for attending this webinar. I plan to do this on a monthly basis. Any questions you have, please feel free to contact hBits or contact me directly. Thank you so much.